This is a brief overview of quasi-reorganization. That's going to be nice in the captions. This discussion covers the situation when a company has had so much financial difficulty that it is looking at the possibility of having to file bankruptcy. In this particular situation, the retained earnings are negative. Also, you'll see that called an accumulated deficit. One possible alternative to bankruptcy is to do a quasi-reorganization. It is a reorganization of the balance sheet accomplished without declaring bankruptcy. It's also referred to as a fresh start. It does require shareholder approval, however, and the auditors, of course, have to be on board that the company has a bright enough future such that it is reasonable to believe the company is a going concern. So the big problem here is negative retained earnings. Basically, this means that since inception, this company has lost more money than it has made. The solution, accomplished through quasi-reorganization, is to use the other equity accounts to absorb the retained earnings debit balance so that the retained earnings balance is reset to zero, thus the fresh start. To make this happen, there's 3 basic steps. You could do this all in one journal entry, or you could do it in 3 different entries. The first step is to adjust the assets and liabilities to their fair value, with any gains or losses going right into retained earnings. You don't mess with the income statement here, because ultimately that income statement is close to retained earnings, and we're trying to clean up retained earnings, so just put things right there to begin with. Step 1 often results in the retained earnings getting even more negative, right? Digging an even bigger hole. Step 2, you use the additional paid-in capital accounts to absorb as much of the negative retained earnings as possible. Since the additional paid-in capital accounts usually have the biggest positive balance in the equity section of the balance sheet, this is often the only additional step that needs to happen. However, Step 3 would occur if necessary. You'd use the common stock account to absorb any remaining negative retained earnings balance. And then you'd have to adjust the par value to fit with the existing number of shares for any balance left in common stock. The result would be that retained earnings has a zero balance and the company can move forward with a fresh start. You have some activities that kind of walk through, and you'll see the journal entries that I would do to make this happen. As always, make sure you ask questions.